Short video today, traders, on the weekly templates. A lot of questions traders have asked me, what do you mean by day 2 shorts, or day 3 shorts, or day 1 longs, that sort of thing. And it's important that you understand the templates so it can give you a thesis for the session that you're trading. So again, coming back, there are traders all around the globe. Some mainly focus on Asia. Some focus on the Europe-London window, and other ones focus just mainly on the U.S. session. And some traders trade all three. But when you study the templates and you understand the setups, we talked about Monday, day 1 starts the week. So regardless of what else has happened, you can always come to the week fresh and start a new week and have a thesis for that day, that session that you're trading, or for the week as it builds up. And so they're all different, and there are some basic templates, and you know, my favorite one is just the 1, 2, 3. So we can get the same setups over the course of a day as we can over the course of a week. We can have 3 days of rise. Now, this is an example on the Swiss franc. Just as a basic template, the first day where longs are in the market, this is a breakout day. That's a breakout day. They've broken the new high, and it's closed as a bull candle. That's day 1. Longs are in the market now. And on the Monday, that market just continues to auction and grind and closes at the high as well. And now we have a day 2 where longs are in the market. Start of the week. So we have talked before about Mondays. Mondays can be inside bars. They can be narrow range days. But they're part of a larger template. And so we have day 1, longs are in. Day 2, longs are in. The same process applies for shorts. And if you're working, a lot of traders get caught up because they during the day, they're looking for the low or high of the day when they go to their session. So for example, on the Monday, they don't want to buy, perhaps, if this was a long setup in the U.S. They don't want to buy because they're waiting for it to get to the high of the day. And it gets up here and they want to short it, except that it's not a day 1 short. And so they get stopped out, they get bombed out, and they get beat up because they're trying to short a day where there's no short setups. So studying the templates will help you understand the bigger picture that's evolving. So on a day 1 that's a runaway day or a continuation day, there may not be any short trades in a long day 1. On the Monday, it's the second day of where longs are in the market. Day 2, though, we are inside, and the market engulfs and gives day 2 shorts Tuesday into a long market. So what that means is during the London session, there were short trades, and that's a short trade into day 2 longs. So this may sound confusing, but if you study these, you'll understand. Even though now the market pulls back in the gap and then goes into a day 2 trending day in the U.S. session, continuing through the high. So there are, number one criteria that I usually have in any day that I'm trading is that a previous day's high or low has been broken. So there was a trade recently where I traded inside like this, and traders say, well, how can you take that? It's inside. Except that what we fail to see is that we have longs trapped in the market, and they've put a peak formation into the end of day 2 longs, gone into consolidation and broke down inside for a day 2 short in the Europe-London session. That reverses and turns into a trend trade in the U.S. session. That is now triggered the high of the day, and we have day 3 longs in the market. So each day this goes further in a trend, the higher up longs are buying into the market. So we get day 1, day 2, day 3 longs in the market. The Fed is that night. They take out the entire range of the day and close as a first red day. And then the next day in the London session, we have the Swiss bank rate announcement for the huge vertical move, which closes out all the way back down through the previous low of the week, where the day one longs got in the market. So understand the longs started on the Friday. Day one longs. Day two, that was our first bull candle day. Day two on the Monday. So this reversal, first green day, starts the process off. That's our first breakout day on the Friday. Day two, up. Day three, up. And then we get the Fed reversal and the move all the way back down. Could even say first green day was our first bull candle day. This is our first breakout day with bulls. Day one, day two, day three. So we've got longs trapped or buying outside on the breakout. So again, that lift, that space, even on the template, now we've got bulls in the market where there's a gap to the previous day's breakout. Again, another giveaway that as they go higher, and we got our first red day trade on the Swiss bank, but that's just one example of understanding the templates. We could look at the euro from last week, and we have Monday. So we go back to the start of the week. This is an example of where we have the low of Friday, and they've gone up in three pushes back inside of the low of Thursday before reversing in the Asian session and taking out that higher low. So no breaks of any highs on Monday, but they reverse inside and break back down in the Europe-London window right into the open of the Europe session underneath of Thursday's low. That starts our day one down. So it's Monday and we have day one down. Shorts are in the market. They're in the market at the close of the session. Tuesday, we have day two shorts. Now day two, this is really important. Day two, if you have a runaway market on day one and you're trying to counter trend it, you're probably going to find that in a large majority of the cases, unless it's a peak formation on a day one runner like this, you're trying to counter trend, it's going to close near the end of the day because they're bringing the market further away. Day two, though, your odds increase 70 to 80% of having a reversal trade. So we've got Asia, London, and then there's a reversal trade in the U.S. window for 50 pips, I believe. So day two, your odds increase of a reversal trade. For example, if you're trading in the U.S., if you're trading in London, you're selling into the low. So even if this is a 25 pip scalp, or if you're in the trade, you need to be aware that you're now outside on day two. So you may be getting trapped. The Asia short, great trade in the Asian session, but we're now day two down. They pull it back inside. So this is where you can really start to understand when you're inside day two shorts, you want it to go outside so we can have a day. The further they get away on day three, again, the more likely your odds increase of having a reversal trade. But if you're selling down low, you can be getting caught now into a short squeeze. The same applies for a reversal day, but they go back up inside. Perfect reason to not be in this market. We had news on this day, hence the wicks, before they reverse the market down on the Thursday and finally break out of the low of the week. Now we're day four down and potentially having the reversal process. One of the things that you'll often see on a day three, so they'll go day one, day two, day three can often be an inside bar. We'll look at an example of that. But we have a higher high. We have longs triggered into the market. Day one longs are caught now. So this is an example of getting longs in the market. And then what do? Trigger the longs, and they go back down to the low of the week. Hit the stops, trigger shorts, day three shorts getting caught now, selling the breakout at the low of the week, getting caught before the market consolidates back inside and closes as a bull candle day, and the process starts again. So now we have day one longs in the market going into Monday, first day of the week. We have day one longs, long on the euro. So that gives you some insight. We have peak formation low, day one longs in the market. This could be day one, day two, day three, and roll over again. Have no idea until we see Monday trade. Or we could see Monday grind higher, get day two longs in the market, and head back towards the high of Wednesday and be in a trend situation. Day one, day two, day three for a trend day. We just bring our longer time frame back up here. Go to a blank chart. Obviously, the euro potentially poised for a reversal. I have no idea. This could still act as a peak formation high, and this market could roll over day one, day two, day three, and retest the lows again. But if you study these templates, again, we can look at any week, and it just helps you form a thesis. You might only get one great trade in the week where it's 50 pips, but it's clean, it's easy to see, there's no analysis paralysis, and it all just comes back to understanding who's caught in the market, who's trapped, where are they trapped, what session is it. So for example, we could look at the Canadian dollar. We had a high of the week from the previous week. We had a low of the week from the previous week. The market on the Monday, day one, auctioned up inside. Now, if we zoom in closer at this and look at the Friday, again, Friday triggers Thursday's low. We have day two shorts in the market, and what do they do straight away? They go back up through the high of the day, back into the breakout area, and go one push, two pushes, three pushes back up inside after triggering shorts on day two for a high of the day sell. Again, they go below the low of the day, but they're back underneath of Thursday's low, and we have shorts in the market, day two shorts in the market at the close. But they reverse on the Monday and go back up to the high of Friday. Now think about that psychology behind that. Shorts are in the market holding on for the follow through. They don't even go back to the low because they've got shorts trapped down low at the close on day two. So they had shorts initially, they might have got stopped out. We got shorts back in the market at the high of the day. We got shorts back in the market at the break of the low of the day, the break of Thursday's low, and the close of the session. And they immediately begin the march back up on Monday and grind their way back up to the high of Thursday. They trigger longs, pull back up inside. Now we got day one longs in the market. Now just to kind of emphasize this, coming back to some simple understandings. High of the week, high of the day, previous day's high broken, heading into the New York Open. This is a classic setup for a session trade, a session scalp. So we've got ramped price action, ramping up in that first hour for the vertical move through the previous day's high at the open of the New York markets. So again, the equity hour takes traders further in the wrong direction before engulfing off of 50. We have a 1, 2, 3. This is the pump right here. So we continue the move, and then there's the pump. Boom, boom. 1, 2, 3, engulfment. So for traders who struggle to understand this, number one, this is our key. This is my signal, my trigger for a potential trade entry. The engulfment is my first starter position. I have a 1-bar stop at the high of the day. So if this was the pair, because we're at the high of the day and I'm looking for the trade, this is a prime candidate on a day one for a session trade. We're at the high of the day. We've broken the previous day's high. We've gone 25 pips above that range in the opening of the equity hour. Engulfment, 1-bar stop, targeting a minimum of the major round numbers. Do you notice that, again, I keep talking about this, pay attention to price. If they bring price up, if they pump it up and keep it going and leave a space between the numbers, the price, the lows of the price, and the major round numbers, be very suspicious because they're trapping traders higher and higher, and that ramping price action, this ramping price action into the vertical move is a dead giveaway. They're going to go vertical back through that on the way back down. So regardless of the template, you can still be in an up day or an up template and still have a session trade. That's really important to understand. As soon as this market breaks through, the first position's at break even. When they pull back up underneath of the previous day's level, so anywhere up here, I'd be adding to that position. It's a 20 pip stop. The other one's already at break even. When this comes down, all of these positions are at break even. As soon as it breaks the swing low, all of those positions are at break even. My primary focus on the first position is to get filled up or at 50 or near 50. The second primary entry is to get filled at or near the previous day's high or low, above the numbers, and we're targeting a minimum of the major round numbers and the low of where that move began. That space is almost a guarantee that they're going to go right through that. Anywhere down underneath here, locking it in, exiting the trade. You can leave a trailer if you want. If it breaks this low, the first thing I would do is adjust the trailer to the initial profit target area as my break-even price level, my stop-out price level. So it's still locking in the trade profit of that last position. So my point being today is study the templates and understand who is getting trapped in the markets. Day one longs, day two longs. The further that move progresses, same goes for shorts. The further that move progresses, the higher the likelihood of you having a reversal trade that will succeed, as opposed to trying to short or go long against a day one pair or instrument that is moving strongly. Hopefully that makes sense. Keep it simple, traders. Start the week off strong. We've got some great opportunities, some great moves last week. It'll be interesting. We've got some coiled up markets. I think we'll see some explosive moves. Enjoy your weekend, and may the markets go with you.